Welcome back to Investing Talk Podcast.
Great to be here.
Today we're tackling a question that many of you have sent in, and it really gets to the core of things. Is Uber Technologies a good time to buy right now?
Yes, Uber. Always a fascinating one.
Definitely. We've, waded through a whole stack of material for the latest financials, what analysts are saying, market reports, news, really trying to get you the clearest picture possible.
A lot to unpack there.
For sure. Our goal today is, well, to cut through all that noise, pull out the key insights, and help you understand what our analysis suggests about this global transport and delivery giant.
We'll look at that big turnaround story, the market landscape now, and what might be coming down the pipeline.
Exactly. And before we get into all that, just a quick reminder, if you find these deep dives valuable, please think about subscribing, maybe liking the video, leaving a comment. It really does help us keep doing this.
Your support means a lot.
It does. And if you're feeling particularly generous, you can always buy us a coffee. It all helps fuel the research.
Keeps the lights on.
Okay, let's get into this financial story then, because it is, well, pretty remarkable. For years, Uber was almost like the poster child for losing money, right? Burning cash like crazy.
Oh, absolutely. That was the narrative for a long time. Growth at all costs.
But the sources we've looked at, they paint a completely different picture now, a real financial comeback. What's the biggest thing you see in their recent numbers that shows this shift?
Well, I think what's really striking is just the scale and the speed of it. So in 2024, they hit, $43.98 billion in revenue. That's up 18% year over year, which is solid growth.
Okay, 18% growth, pretty strong.
But the really big number, the headline grabber, is the net income. $9.86 billion in profit for 2024.
Profit, $9.86 billion.
Billion, yeah. And you have to remember, just 2 years before that, 2022, they posted a loss of $9.24 billion.
Wow. That's an incredible swing from a $9 billion loss to almost a $10 billion profit in 2 years.
Exactly. It's not just, tweaking things around the edges. This suggests a fundamental change in how they operate, focusing squarely on profitability. Things like better pricing, the Eats business contributing more, and just finding efficiencies from their massive scale.
Right, that makes sense. But, we always say earnings are one thing, but cash is king. What about their cash flow? Is the cash actually coming in?
Good question. Always critical.
Right.
And, yeah, the cash flow picture is strong, too. Operating cash flow hit $7.14 billion in 2024. That nearly doubled from 2023.
Doubled operating cash flow.
Okay. And then free cash flow, that's the cash left after they cover operating costs and capital spending. That was even better. $6.89 billion. That's up a staggering 105%.
Whoa, 105% increase in free cash flow.
Right. So it shows they're not just reporting profits, they're actually generating substantial cash. And that's crucial for paying down debt, investing, maybe buying back shares, all that good stuff. It signals real financial muscle.
So pulling these threads together, the profit jump, the strong cash flow, solid revenue growth, what does this mean for their overall financial health, their stability?
Well, it fundamentally means their balance sheet looks much, much healthier. Their total debt actually went down to about $11.13 billion in 2024.
Okay, debt reduction is good.
And their debt-to-equity ratio, basically how much debt they have compared to their own capital, improved dramatically.
Yeah.
It went from 1.05 in 2023 down to 0.52 in 2024, so much less leverage.
Much better ratio.
And importantly, they got investment-grade credit ratings last year. That's a big seal of approval. Plus, they started buying back shares $1.2 billion worth under a bigger $7 billion plan.
Buybacks too.
Yeah. All these things together point to a company that's financially robust, managing its money well, and has the confidence and the ability to return value to shareholders. It suggests more resilience.
Okay, so the financials tell a story of a major turnaround. Let's look beyond the numbers. Uber just feels massive everywhere. How strong is their actual position in the market globally?
Yeah, their market presence is definitely a key part of the story, and it relates to their competitive advantages, their moat, if you will.
Right, the moat.
The numbers are pretty staggering. As of the first quarter of 2025, they had 170 million monthly active platform consumers, MAPCs. That's up 14% from the year before.
170 million active users every month.
And they handled over 3 billion trips in just that one quarter. They operate in, 70 countries, over 10,000 cities? The scale is immense.
And that scale creates those network effects we talk about, right?
Absolutely. It's a classic example. More riders attract more drivers, which means shorter waits and better service for riders, which attracts even more riders.
Yeah.
It's that virtuous cycle.
Makes it tough for smaller guys to compete.
Very tough. And it's hard for new players to break in when that network is already so established.
But what about keeping those customers? Is it just convenience, or do they have ways to build loyalty?
That's where something like Uber One comes in, their membership program.
The subscription.
Right. It's grown incredibly fast, reached 30 million members, which is up 60% year over year.
60% growth in members.
Yeah.
Right.
And it does a couple of things. It brings in steady, higher margin revenue, which is great. But maybe more importantly, it makes customers much stickier. They get discounts, perks. They're less likely to switch to a competitor for a single ride.
It builds loyalty, deepens that moat you mentioned.
Precisely. It locks users into their ecosystem. Convenience, savings, habit. It all reinforces their dominant position.
Okay, so strong financials, dominant market position. Given all this positive momentum, how is the market actually valuing Uber right now? And what's the vibe on Wall Street?
All right, valuation. Uber's market cap is currently hovering around $195 billion, so a huge company.
Almost $200 billion.
Yeah. Now, if you look at its price-to-earnings ratio, the PE, it's sitting at about 16.31.
16.31. That actually sounds pretty reasonable, doesn't it? Especially for a tech company with that kind of growth and turnaround.
It does, yeah. I mean, compared to a lot of other high-growth tech stocks out there, it looks, frankly, quite attractive on that metric. It suggests the market isn't demanding an outrageous premium, potentially leaving room for upside if they keep executing.
So maybe not overly expensive despite the good news. What about the analysts? Are they all on board, or are there some doubters?
It's interesting. The overall consensus is definitely positive. We're talking 33 analysts covering it, and the consensus is a strong buy.
Strong buy.
The average price target is around $96.87, which, suggests maybe about 4% upside from where it's trading now.
Only 4%. Seems a bit low given the strong buy.
Well, that's the average. The range is actually pretty wide. You've got targets from $77 all the way up to $115.
Oh, okay. Big range.
Right. So, for example, you have Stiefel initiating with a buy and a $110 target. They're clearly bullish long term. But then you have Nomura, who recently downgraded it to neutral with a $62 target.
$52, that's quite bearish compared to the others.
It is. So while most analysts are positive, there are definitely some differing views out there, perhaps focusing more on short-term valuation concerns or specific risks. It's not unanimous.
Okay, that makes sense. Now, this brings us right to the core question for many listeners. The stock price itself, it's had a fantastic run this year. What's the current chart action telling us about buying now?
Right, the timing question. The stock's around $93.12 currently. Year to date, it's up over 47%. That's a huge gain.
Over 47%. Wow.
It's trading very close to its 52-week high, which was $93.60, and it's comfortably above its key moving averages, the 20-day and the 50-day. Generally, those are bullish signals, suggest strong upward momentum.
Okay, momentum looks strong. But I've heard that term overbought thrown around. What does that mean practically for someone thinking of jumping in? Could it be due for a breather?
That's exactly the concern, and it's where the technical indicators come in. The Relative Strength Index, the RSI, is currently at 71.05.
Over 70.
Right, and generally a reading above 70 is considered overbought. It suggests the price might have moved up too far, too fast, and could be vulnerable to a near-term pullback or consolidation.
So, a caution flag from the RSI. Anything else?
Well, the MACD indicator, that's moving average convergence divergence, it also shows bullish momentum, but there's maybe a hint of divergence starting to appear, where the indicator isn't quite confirming the price highs.
Divergence. Another potential warning sign.
It can be, yeah. It doesn't guarantee a drop, but like the RSI, it suggests maybe the upward momentum is losing a bit of steam. Add to that, volatility is still pretty high, over 33% annualized, so the potential for sharp moves, maybe downwards in the short term, is definitely there.
Okay, so fundamentals look great, but technically maybe a bit stretched in the near term. Let's look ahead then. What are the big potential catalysts that could push the stock higher? And what are the risks that could derail things? Let's start positive.
Okay, catalysts. I think the really big one, the potential game changer, is their autonomous vehicle strategy.
The self-driving future.
Exactly. And Uber's playing it smart, I think. They're not trying to build the cars themselves mostly. They're positioning themselves as the platform, the network that integrates other companies' AVs.
Partnering up.
Right. They have something like 18 different AV partnerships globally. Think May Mobility, WeRide. And the big one is Waymo, Google's AV company.
Waymo partnership, yeah. How's that going?
It just launched in Atlanta in June. After what sounds like a successful run in Austin, apparently the Waymo vehicles there had over 99% utilization compared to human drivers.
99% utilization, that's
It
huge.
is. If they can roll this out widely, integrating AVs onto the Uber network could fundamentally change the economics, lower costs per trip, potentially higher margins. It's a massive potential catalyst for long-term profitability.
A real game changer, as you said. What else is on the horizon?
Well, shorter term, you've got their Q2 earnings coming up, probably in August. Management's guidance was positive, so strong results there could give the stock a boost.
Okay, earnings beat potential.
And longer term, there's still room for expansion in many international markets. Plus, just ongoing tech improvements, using AI for better routing, pricing, matching that can drive efficiency. And the whole mobility as a service market is projected to be huge, over $520 billion by 2027. Uber's right in the middle of that.
Lots of potential growth drivers then. But we have to look at the other side too. What are the major risks, the headwinds, that investors need to keep in mind?
Absolutely crucial to balance the picture. Competition is still intense.
Hmm.
You've got Lyft in the US, Didi in China and other markets. Ride-hailing isn't impossible to enter, so there's always pressure on market share and pricing.
Constant competitive pressure.
Right. And while Uber's partnering on AVs, there's also the risk that companies like Tesla or maybe Amazon's Zoox could build their own competing ride-hailing networks using their own AVs. That could disrupt Uber's platform model.
The regulatory side too, that's always been an issue, hasn't it?
Always. There's an ongoing FTC lawsuit about the Uber One subscription, actually. And the whole driver classification issue, employee versus contractor, that pops up again and again in different places. That creates uncertainty and potential cost increases.
Yeah, that seems like a constant battle.
It is. And then you have broader economic risks. If there's a downturn, people cut back on discretionary spending like rides and food delivery, rising insurance costs, volatile fuel prices. Those can squeeze margins for Uber and its drivers. These are definitely significant risks to watch.
Okay, so we've really covered a lot of ground here. A remarkable financial turnaround, a dominant market position with strong network effects, an exciting AV strategy.
But also some caution flags from the technicals right now, plus ongoing competition and those persistent regulatory and economic risks.
So putting it all together, where do we land?
Well, weighing everything up, our analysis gives Uber an overall investment rating of, let's say, 7.5 out of 10.
It's 7.5 out of 10. Okay.
The fundamentals look strong, no doubt. And the long-term story, especially with AV integration and mobility as a service, is compelling. But as we discussed, the technicals suggest it might be a bit extended right now for short-term entry.
So for you, our listener, thinking maybe longer term, say 2 to 5 years out, what might be a sensible approach?
For that longer-term investor, our analysis points towards an optimal entry price range of around $85 to $88.
$85 to $88, so a bit lower than where it is now.
Right. The thinking is this range could let you potentially take advantage of a near-term pullback, given those overbought signals we talked about. It aligns with some technical support levels, too. It might offer a better risk-adjusted entry point to capture that long-term potential we see.
Get in at a potentially better price if the stock takes that breather the charts hint at.
Exactly. It kind of leads to that bigger question for a company like Uber, doesn't it? How much of that exciting future, especially the AV part, is already baked into the current price? And how much upside is left for investors who are patient?
A key question indeed. That balance between today's price and tomorrow's potential.
It always is.
Well, we hope this deep dive has given you a much clearer, more nuanced view of Uber technologies and helps you think critically about whether it fits into your own investment strategy.
Hopefully provided some useful context and things to consider.
Thanks so much for joining us for this deep dive,
Always a pleasure.
and we look forward to the next one.